Good morning, it's Monday, June 22nd. I'm Matt Moklestad, lead advisor at Foster Group, and this is our Financial Perspectives update covering market and economic news and an additional special topic. And today, I will be covering how COVID-19 has impacted real estate investment trusts, or REITs. For those of you who don't know who Foster Group is, we're an independent registered investment advisory firm that has the privilege of serving over 1,400 clients across the United States. So moving on to news over the last week, the Commerce Department reported retail sales sharply rebounding in May by 17.7% from a month earlier. And overall, this just shows that as states gradually reopen, economic activity is increasing, people are out spending money, and overall, that's a really encouraging development. And what the graph shows you in the middle is retail sales in May by sector. And in the dark blue, it shows change from the previous month, which tend to be towards the right side of the graph. And then the lighter blue changed from a year ago. And you can see that change over the last month has been very strong, especially for some retail sectors. But overall, from a year ago, there's still quite a bit of ground that needs to be made up. The Labor Department reported that 1.5 million workers applied for unemployment benefits the week ending June 13th. And overall, as you can see in the graph, that shows a continual trend downward. That's actually been happening in the last 11 weeks. But overall, the pace has slowed just a bit, showing that the overall pandemic is still having a negative impact on the jobs market. Looking at a few other news headlines, more than a dozen US states saw actual rise in coronavirus cases. Some of those states included Arizona, Texas, North Carolina, which made investors a little nervous at the start of the week. The Trump administration is preparing a $1 trillion infrastructure package as another way to boost the economy. There's still quite a bit that needs to be done there, but investors seem to respond favorably to that news. Applications for US home loans hit its highest level in 11 years as more Americans take advantage of low interest rates. And actually today, New York begins its second phase of reopening, with restaurants offering outside seating and some more employees getting back to their offices. If we look at market news, major stock market indexes in the US and overseas increased last week, with the S&P 500 up 1.88%, and then the MSCI All Country World Index, ex-USA, up 1.85%. Bonds on the other side saw a relatively calm week. Government yields were mostly unchanged and steady. Corporate yields fell modestly, and the Barclays US Aggregate Bond Index was up 20 basis points. And this graph here shows you just what that looked like. The S&P 500 in the blue, international in the orange, and fixed income in the light blue. So things started off negative. They popped on Tuesday with some of the news on retail sales, for example, and then mostly stayed steady, fairly steady throughout the rest of the week. So moving on to our topic, how has COVID-19 impacted real estate investment trusts? Well, before we dive into this, I thought I'd first just review the question, what is a REIT in the first place? Well, a REIT, or real estate investment trust, is a company that owns, operates, or finances income-producing real estate. Modeled after mutual funds, so it takes a pool of investors' capital and invests it. REITs have historically provided investors of all types regular income streams, diversification, and long-term capital appreciation. And that is why Foster Group, we've allocated a portion of our portfolios to REITs over time. Investors get diversification to broad market indexes, and they've offered equity-like returns over time. So how have REITs, broadly speaking, done year to date through June 19th? Well, this is a look at broad US markets in the dark blue, international in the orange, fixed income in the light blue again, and then we have the S&P developed REIT index in the purple. And you can see that overall, REITs have taken it a little bit harder compared to those broad market indices. Through mid-March, they were down just over 40%, and they haven't recovered as strongly as broad stock market indexes, still down roughly 20% through the end of last week. However, to really address the question, well, how has COVID-19 impacted real estate? We really need to take a deeper look, because it depends on the type of real estate. And what this shows you here is a breakdown of the real estate sectors or different types of REITs in the S&P Developed REIT Index. So you can see that within the actual asset class, there's diversification of property types. It ranges from things like industrial REITs, residential, retail, office, healthcare, and hotel and resorts. And each of the pieces of these pies has performed differently, some very differently year to date. And this is a picture of that. This shows the REIT sector returns through 6/19. And you can see that the range of returns has been very wide. At the top in the light blue, we have specialty REITs. So this includes things like data centers, public storage, and they have actually done very well year to date, up just over 9% for the year. Just below that in the green, we have industrial REITs. So that includes things like warehouses, distribution centers, and those are also positive, up 2.78% through the year. And you can see that other sectors have experienced some pretty significant disruptions. Hotel and resorts are at the bottom of the pack. It is only 3% of the index, that piece of the industry, but hotel and resorts are down just over 45% year to date through last week. And retail REITs are down just over 36.5% in the red. So the type of real estate really matters. And another area that has gotten a lot of attention has been office REITs. And that's that orange line that I just highlighted here for you. It represents 13.7% of the index. And this year, office REITs are very much in the middle of the pack, down 23.72% year to date. And although they're somewhat in the middle right now, there's been a lot of talk, a debate on what's going to happen going forward. Many of us have speculated that the new work from home policies will ultimately lead to office REIT demand collapse. So, given the circumstances, it's easy to probably come to the worst of conclusions, but there are really several things to consider here before we would want to do that. And recently, MetLife Investment Management had a paper on this topic, and they have 4 factors that should be considered when determining the impact coronavirus will ultimately have on office demand. And those factors are: 1, the number of workers who will permanently begin working from home full-time, the number of workers who will adopt flexible schedules, such as working from home, say 1 or 2 days a week, how firms will change space needs as a result of flex working, and 4, how firms will change layouts to better prepare for future pandemics. So to first cover those first 2 factors on more people shifting to working from home, there's a recent survey done by Gartner Inc. It's an S&P company, and they asked 317 CFOs or chief financial officers the question: what percentage of your workforce will remain permanently remote post-COVID-19 and who are not remote already? And the answers range from 0% on the left all the way to more than 50% on the right. And you can see that if you add up the blue bars there, that 74% plan to permanently shift at least some of their workforce to remote work post-COVID-19. However, if you look towards the right, only 6% plan to move 50% or more of their workforce permanently remote. So, first off, when it comes to surveys like this, in my opinion, you always need to take things like this with a grain of salt. But I think it's safe to say that as a result, yes, more people will probably be working from home, at least full-time and at least part-time going forward. The question is to what degree. Another thing to consider is the space component. So over the last 10 years especially, this is a look at office square footage per employee. And over the last 10 years, office square footage per employee has decreased. So question now with social distancing and the impact of the virus is that to support a sustainable workplace going forward, will this need to be increased? So will the space per employee or square footage per employee actually need to reverse trend and increase going forward to accommodate a more sustainable workplace. So those are all really important considerations that will have a pretty big impact on the overall impact on office real estate going forward. There's actually quite a number of other things to consider here that we don't have time to cover, but one of those is that office buildings, they typically have longer term lease arrangements over a number of years. So many tenants, although maybe they like to do something now, they're locked into their leases for a while going forward and may not even be able to address this for a number of years. And who knows how different things will look 2, 3, 4 years from now. So in summary, just to sum things up here, ultimately, as always, time will tell what the ultimate impact this unprecedented time will have on real estate and many other things for that matter. But I think this year is a reminder that the unexpected happens. No one would have expected we'd even be having this conversation just a year ago, but here we are. And because of that, diversification, it's really important across the portfolio and within asset classes as well. So that sums things up. Thanks so much for attending. If you have comments or questions for the team at Foster Group, you can email us at the email address on your screen. If you want to learn more about our firm, you can check out our website. And if you want to request a meeting with an advisor, you can also visit our website at the bottom link on your page. Thanks so much.